The balance sheet of an entity can be depicted as the perfect balance between the firm's resources and its capital structure. The resources consist of the assets the firm deploys in its attempts to earn a return. The capital structure consists of the amounts contributed by outsiders in the form of debt and insiders in the form of equity to make the use of these assets possible. Arriving at the appropriate mix of debt and equity in the capital structure is a challenge all corporations face. Each component of the capital structure bears a cost that changes as economic conditions change and as more or less of that component is deployed. Bonds are the principal form of long-term debt financing for corporations and governmental entities. A bond is a formal contractual obligation to pay an amount of money, called the par value, maturity amount, or face amount, to the holder at a certain date, plus, in most cases, a series of cash interest payments based on a specified percentage, sometimes called the stated rate or coupon rate, which is of the face amount at specified intervals. All of the terms of the agreement are stated in a document called an indenture. In general, the longer the term of a bond, the higher the return demanded by investors to compensate for increased risk. This relationship is the term structure of interest rates. A bond indenture may require the issuer to establish and maintain a bond sinking fund. The objective of making payments into the fund is to segregate and accumulate sufficient assets, including earnings of the fund, to pay the bond principal at maturity. Why does a company utilize bonds as a form of long-term debt in their capital structure? Let's go over the advantages of bonds. Interest paid on debt is tax deductible. This is by far the most significant advantage of debt. For a corporation facing a high marginal tax rate, the tax savings produced by the deduction of interest can be substantial. Also, basic control of the firm is not shared with debt holders. That is an advantage of debt financing over equity financing. Financing with bonds also has some disadvantages for the borrower. Unlike returns on equity investments, the payment of interest and principal on debt is a contractual obligation. If cash flow is insufficient to service debt, the firm could become insolvent. The contractual requirement to interest and principal increases a firm's risk and reduces retained earnings. Shareholders will consequently demand higher capitalization rates on retained earnings, which may result in a decline in the market price of the stock. Bonds may require some collateral that restricts the entity's assets. The amount of debt financing available to the individual firm is limited. Generally accepted standards of the investment community will usually dictate a certain debt-to-equity ratio for an individual firm. Beyond this limit, the cost of debt may rise rapidly, or debt may not be available. So let's go over the different types of bonds, starting with James Bond. No worries, just checking to see if you're paying attention. So let's try that again. The different types of bonds. A term bond has a single maturity date at the end of its term, whereas a serial bond matures in stated amounts at regular intervals. Variable or floating rate bonds pay interest that is dependent on market conditions. Zero coupon or deep discount bonds bear no stated rate of interest and thus involve no periodic cash payments. The interest component consists entirely of the bond's discount. Commodity-backed bonds are payable at prices related to a commodity, such as gold. Some bonds have redemption provisions. Callable bonds may be repurchased by the issuer at a specified price before maturity. During a period of falling interest rates, this allows the issuer to replace old high-interest debt with new low-interest debt. Callable bonds typically have higher interest rates than comparable non-callable bonds. Convertible bonds may be converted into equity securities of the issuer at the option of the holder under certain conditions. The ability to become equity holders is an inducement to potential investors, allowing the issuer to offer a lower coupon rate. Mortgage bonds are backed by specific assets, usually real estate. Debentures are backed by the borrower's general credit, but not by specific collateral. Registered bonds are issued in the name of the holder. Only the registered holder may receive interest and principal payments. Bearer bonds are not individually registered. Interest and principal are paid to whomever presents the bond. Subordinated debentures and second mortgage bonds are junior securities, with claims inferior to those of senior bonds. Income bonds pay interest contingent on the issuer's profitability. Revenue bonds are issued by governmental units and are payable from specific revenue sources. Investors can judge the creditworthiness of a bond issue by consulting the bond rating assigned by a credit rating agency. The higher the rating, the more likely the firm is to make good its commitment to pay the interest and principal. The three largest firms are Moody's, Standard & Poor's, and Fitch. Investment-grade bonds are considered safe investments, and thus have the lowest yields. The highest rating assigned is AAA. Some fiduciary organizations, such as banks and insurance companies, are only allowed to invest in investment-grade bonds. Non-investment-grade bonds, also called speculative-grade bonds, high-yield bonds, or junk bonds, carry high risk. The ratings range from BB+ to DDD.